You're probably already aware that significant changes are unfolding in the U.S. markets. Recently, the market saw another dramatic drop, with the index closing below 20,000 after losing 1,300 points. This significant decline highlights the increasing volatility and uncertainty in the markets, something that investors should not ignore. As the landscape shifts, the stakes for individual investors are rising, and now more than ever, it's crucial to understand what's happening beneath the surface. In this video, we'll dive deep into the views of industry professionals regarding the current economic situation, particularly focusing on the latest developments and why Michael Burry's warnings seem more relevant than ever. Before we continue, don't forget to hit the like and subscribe buttons to stay updated on future videos, where we'll continue exploring these critical topics. The unexpected about-face in the outlook for the U.S. economy has led to some disturbing new lending practices, signaling growing uncertainty and risk in the financial sector. As we see these changes unfold, one thing becomes clear: Michael Burry, one of our favorite contrarian investors, was right all along. Burry has long been warning about the dangers lurking in the economy, and his predictions are now starting to gain widespread attention from major financial institutions, including Goldman Sachs. In this video, we'll explore Burry's track record, what his predictions have been, and how they align with the latest warnings from Goldman Sachs about the future of the market. We'll also examine how these shifts are impacting investor sentiment and the economy as a whole. For those who might not be familiar with Michael Burry, let's quickly recap his story. Burry's fame came from his ability to foresee the collapse of the U.S. housing market in the mid-2000s. His predictions were based on thorough research into the subprime mortgage market. In 2004, he recognized the unsustainable lending practices of mortgage lenders who were issuing subprime loans to individuals who had little ability to repay them. Burry understood that these risky loans would eventually collapse, and he made a bold decision to bet against the housing market by purchasing credit default swaps, CDS, a type of insurance against loan defaults. At the time, few people understood the risks involved with these financial instruments. Many executives in the big Wall Street firms issuing these bonds didn't even fully comprehend the details of the contracts they were selling. Credit default swaps allow the buyer to protect themselves from the risk of default by the underlying asset, such as a mortgage-backed security. It's essentially a form of insurance where the buyer can collect payments if the asset defaults. In the case of Burry's strategy, the gamble paid off handsomely. When the housing market collapsed, Burry's fund returned over $700 million in profit to investors, and he earned a personal fortune of over $100 million in the process. However, despite his immense success, many critics have questioned Burry's bearish predictions, claiming that if someone keeps predicting a crisis, they'll eventually be correct. The media and some investors have dismissed his views, arguing that he's simply a doomsayer. But now, with inflationary pressures continuing to rise and the market showing clear signs of stress, Burry's insights are gaining increasing relevance. Goldman Sachs, one of the world's largest investment banks, is now sounding alarms that echo Burry's earlier warnings, suggesting that the economy may be facing more turmoil in the near future. Goldman Sachs chief market economist Dominic Wilson and strategist Vicky Chang recently released a report to clients that aligns with Burry's predictions. In this report, Goldman Sachs issued a stark warning about the S&P 500, suggesting that the index could fall another 27%, dropping to below 2,900, if the Federal Reserve continues with its current course of quantitative tightening. This tightening could occur if the unemployment rate reaches 6%, as the Fed has signaled it might be necessary before any reversal of current policies. Goldman's report included a graph showing the potential outcomes for the market depending on which scenario the Federal Reserve pursues, either a severe or a more moderate approach. Their analysis is eerily similar to the warnings that Burry has been issuing for months now, highlighting the possibility of significant market declines if inflationary pressures remain unchecked. The release of the recent CPI, Consumer Price Index, data has been a game changer for the market. The report showed that inflation rose by 0.1% in August, which was a catalyst for many financial analysts and media outlets to change their outlook. Had the CPI remained steady, or dropped by 0.1%, the media narrative would have likely remained the same, with optimistic projections for GDP growth continuing to dominate the conversation. However, the fact that inflation is still rising despite significant drops in gas prices suggests that inflationary pressures are far from under control. This shift in the narrative is precisely what Burry has been warning about. The tipping point for the market has arrived. It's all about finding the right moment when the narrative flips and starts to crush the bulls who have been holding on to the previous story of economic recovery. Goldman Sachs has added that Chairman Jerome Powell of the Federal Reserve may need to make difficult decisions in the coming months. As inflation remains persistent, Powell will likely face immense pressure to continue raising interest rates. Goldman's analysts predict that the Fed may opt for a 50 basis point increase in September, which would further tighten financial conditions. This, in turn, could exacerbate the challenges facing the market, as higher rates generally lead to slower economic growth and lower stock prices. The key takeaway here is that the financial world is increasingly aware that inflation is still a serious issue, and the potential for further economic struggles is high. In Goldman's view, the market hit its bottom on June 16, but the idea that the market has already recovered is, in their opinion, based on unrealistic expectations. They caution investors against believing in the narrative that the worst is over, as many others in the market are already beginning to reverse their earlier optimism. The fact that inflation is still rising despite falling gas prices suggests that broader economic conditions are not as stable as many would like to believe. This is precisely the kind of environment in which Burry thrives. His ability to see through the hype and understand the underlying risks has made him one of the most respected figures in the investment world. As we consider these developments, we must ask, do you agree with Goldman Sachs and Michael Burry? Both have warned of an impending market downturn, and with the latest CPI data, their concerns seem more prescient than ever. While there's hope that the economy might recover, it's also wise to prepare for the possibility that things could worsen before they get better. If the current trajectory continues, the fallout could be severe, especially for those who are unprepared. For individual investors, the key takeaway is to stay informed and cautious. As always, it's essential to have a diversified portfolio and to understand the risks involved in any investment strategy. While the future may hold potential opportunities, it's also a time for careful consideration of market trends and a recognition of the broader economic forces at play. Michael Burry's insights have proven to be invaluable in the past, and his warnings today may very well be pointing to the next crisis. In times like these, preparation and a long-term mindset are critical. If you found this video informative and thought-provoking, don't forget to give us a like and subscribe to stay updated on future content. We'll continue to monitor these developments and bring you the latest insights from top investors like Michael Burry and financial institutions like Goldman Sachs. Let us know in the comments what you think about the current state of the economy and whether you agree with the predictions of a market downturn. Your thoughts are always welcome. Thank you for watching, and we'll see you in our next video. If you're looking for more content on the current state of the economy, check out our previous video on Michael Burry's recession predictions. See you there.